All right, everyone. Welcome to Chapter 6. We're going to be talking about business formats and fitting the format to your business. So, when you're choosing the format that you want your business to run under, you need to make sure that you're choosing the right one, right? Because there's lots of different plans that businesses can follow. Businesses and managers and entrepreneurs need to figure out which one's best for them. So there's four primary ones, right, that we're going to learn about. So one of the most important decisions an entrepreneur makes when starting a business is which form of business ownership to use. It impacts every decision going forward, including the initial cost of setting up the business, right? Because each business type has different costs for setting up, the way profits are distributed amongst individuals, owners, or shareholders, the type and amount of taxes that you pay, and lots of other things. The form of business chosen also determines the degree to which each owner is personally liable for the firm's debts and sources of funds available to the firm to finance future expansion. Choosing the right strategy helps entrepreneurs survive. 20% of new businesses fail within the first year, and a third fail within 2 years, and 37% of Fortune 400 businesses are expected to fail every 5 years. Right, so this is a pretty big problem. During the pandemic, though, the new company registration rose by 82% in the United States. So that's why, even though the economy was in shambles, it was also very strong at that time. So most businesses fall under one of four categories. So first up, we have sole proprietorship. That's when business owners, the business is owned and usually managed by a single individual. Simply, it's an extension of the owner, right? The company's earnings are treated just like the owner's income. Any debts are considered to be the owner's personal debts, and it's known as unlimited liability, which we'll talk about in a little bit. Partnership is another primary one, which is an agreement under which two or more people act as co-owners of a business for profit. Several different types of partnerships, which again we'll cover in more detail in just a little bit. The basic form of partnership is called a general partnership, right? And a general partnership is when each partner has the right to participate in the company's management and share in profits. Up next, we have corporation, which is a form of business ownership in which the business is considered a legal entity that is separate and distinct from its owners. The corporation is considered to be a legal entity that is separate and distinct from its owners, right? So it's separate from their income, their liabilities, things like that. Meaning the corporation can engage in legal acts such as bringing on contracts or creating contracts, borrowing money, owning property, paying taxes, and engaging in lawsuits under its own name. It's not under the name of the original owner or the person that started up. It's under the name of that company, such as Apple or Google or Microsoft, any company out there. So, limited liability company is our fourth one that we're going to talk about, which is a form of business ownership that offers both limited liability to its owners and flexible tax treatment. Business is considered to be its own legal entity. Owners have limited liabilities for their debts and their business, so they don't have to take on all of the debts. They're not responsible for all of the debts or all of the liabilities of the business. And in terms of flexibility, LLC owners can elect to have their businesses taxed as either a corporation or a partnership, right? So there's that flexibility. What's right for you? Because every situation is going to be different. Some people want to be taxed as a corporation, some as a partnership, and you'll have to navigate that legal system generally with probably a CPA. Or it could be taxes as part of the owner's personal income as another alternative as well. So let's start talking about advantages and disadvantages of a sole proprietorship, right? Because there's lots of different types of businesses. We need to figure out what's the benefit of a sole proprietorship. So first off is ease of formation, right? In terms of creating the business, the paperwork and costs involved is pretty minimal. There's no special forms that need to be filed and no special fees need to be paid. There's retention of control, pretty much meaning you're in control. You get to call the shots. Some believe that the more cooks are in the kitchen, the more likely there is to be a disagreement, right? So if you don't have to argue or discuss with other individuals, you know your business is going to be on the plan that you created, and you can't blame anybody but yourself for its success or failure. There's also that pride of ownership. Another benefit, retention of profits, right? You get to keep the money. And possible tax advantages depending on your situation, how taxes are levied, if they're going to be, would it be more beneficial to have them taxed on your personal tax return or not? So some of the disadvantages of sole proprietorships, right? Because not everything is sunshine and rainbows. Limited financial resources. You're kind of not really flushed with cash. That could be a problem. Unlimited liability, since the business is the extension of the owner, all of the liability falls on the owners. That includes your lawsuits and debts. You have limited ability to attract and maintain talented employees, mainly because you can't pay high salaries as compared to a big mega corporation. And a lot of times you have a heavy workload and responsibilities. All the work falls on your shoulders, right? It's pretty much all you since you are the entrepreneur. And there's lack of permanence. Since the business is an extension of the owner, if the owner dies, retires, or withdraws from the business, the company legally ceases to exist. So that could be a problem. Up next, we have partnerships. So let's talk about formation of general partnerships, right? So there's no limit on the number of partnerships that a person could participate in a general partnership, forms. Oftentimes, it's just two, though. So partnerships are formed when partners enter in a voluntary agreement. You could legally start a partnership on the basis of a verbal agreement, right? So you could pretty much say, let's start a business, and that verbal agreement will be good enough. You want to kind of avoid doing this, though, because it could actually be disastrous, right? You want to hash out all the details. Having a professionally written document is a much better approach. Why? So that way you know who's responsible for what, who's expected to do what. Well-written documents are going to avoid common misunderstandings and avoid potential lawsuits, right? Because they're not fun. So some advantages of general partnerships is the ability to pool your financial resources together, right? Because as an individual, you might not be able to back the entire business yourself. The ability to share responsibilities and capitalize on complementary skills is another great benefit. Ease of formation. It's pretty easy to actually form this business based on the lack of fees and paperwork, as well as possible tax advantages, dependent on your situation, your income level, your state, things like that. However, as we know, not everything is all sunshine and rainbows. There are some disadvantages of general partnerships. So first off is unlimited liability. As a general partner, you are liable, right? There's not a limit on the amount of liability that you have for both your assets, your debts, your liabilities, things like that. There's also potential for disagreements. As we said before, the more people there are, the more likely it is to engage in disagreements, which can cause issues later on. Lack of continuity. If the current partner withdraws from the partnership, the relationships will clearly change, and that could end up ending the business, which is very not good, obviously, especially if the other partner wants to keep it going. And there's also a difficulty withdrawing from the partnership, right? Because of what we just said. Lots of issues can arise. So let's talk about limited partnerships, right? So the risks associated with unlimited liability makes general partnerships unattractive, right? Unlimited liability is clearly something that is obviously not something that we want. Thankfully, there are two other types of partnerships that allow partners to limit their personal liability to some extent. We can't obviously eliminate it totally, but we can limit it. So that brings up limited partnerships, which is a partnership and agreement that includes at least one general partner and at least one limited partner. Both partners contribute financially and both share in the profits still. However, one person essentially actively manages the company and accepts the unlimited liability. The other person gives up the right to actively manage the company in exchange for limited liability. Limited liability partnerships is a form of partnership in which all partners have the right to participate in management and have limited liability for company debts. Partners here have limited liability for all claims against their company except those resulting from their own negligence or malpractice. So some states actually make it so the partners have limited liability for partner malpractice as well. We won't get into that because that gets specific based on the state that you live in. Excuse me. So up next, let's talk about corporations. So there's actually several different types of corporations. The most common is called a C corporation, which is what we're going to talk about primarily today. C corporation, most common type of corporation, which is a legal business entity that offers limited liability to all of its owners. So it sounds like a pretty sweet deal. So first off, how do we form one? So forming a C partnership requires filing articles of corporations as well as filing fees. It also requires adoption of corporate bylaws. You've probably heard of that term before. Essentially, they're basic rules governing how a corporation is organized and how it conducts its business. Becoming a corporation also requires they need a board of directors, issue stock certificates to initial shareholders, and appoint a registered agent to receive legal and tax documents on behalf of the corporation. Becoming a corporation typically requires a lot of money up front, as it's much more expensive than any of the others that we've talked about, and requirements vary from state to state. So when we talk about ownership of corporations, it's represented by shares of stock, which we all know what stock is. And that makes the owners the stockholders. So if you own stock, you're technically a owner of the business. You might only own 0.0001%, but you can rest assured that you do own a slice of that apple pie that Apple offers us. So stock comes in two forms, common and preferred. The key difference is with common stock, normally you have the right to vote, and those with preferred stock do not. Sorry. Apologize for that error. So stock in large corporations are usually publicly traded. And they're not always individuals. Sometimes they're mutual funds, them investing companies, things like that. So it's not always an individual that owns or is a part owner of a company. Figured I'd throw that out there. So there are some advantages. Limited liability, as we talked about, great benefit. Permanence, it's going to continue on even if there's an issue with a specific individual, as long as they remain financially viable. Ease of transfer of ownership. Stockholders can simply sell their shares of a corporation to another business or individual. Ability to raise large amounts of financial capital, right? They have a large backing, so it's easy to raise money. And the ability to make use of specialized management, right? Because you have more money, you're essentially able to hire more qualified individuals, which is a huge benefit. Some of the disadvantages is the expense and complexity of forming an operation, a C corporation. As we talked about, there's a lot that goes into it when it comes to getting into the stock market, the different forms, the upfront capital makes it a lot more difficult. There's complications when you're operating in more than one state. Each state has its own set of rules, and each state essentially has different laws that you have to abide by. Essentially, you're kind of looked at like a foreign company almost. So it can get a little complicated that way. More paperwork, more regulation, less secrecy. Can't really cover anything up or sweep any minor issues under the rug because people are going to be disclosed that information. And there's always potential conflicts of interest based on everyone's specific situation. Now let's talk about the limited liability company. So forming and managing an LLC, right? Created by filing a document and paying filing fees in the state in which your business is organized. Since LLCs are neither a corporation or partnership, owners are called members rather than stockholders or partners. And some are run by creators, the creator of the business. Some are run by managers. Varies from situation to situation. They have some advantages such as limited liability, tax pass-through. So for tax purposes, Owners can elect to have their companies treated as a corporation or a partnership, or even a sole proprietorship if they're owned by a single person. The earnings essentially pass through the company and are taxed on as the income of the owners, and eliminates double taxation of profits, which is a huge benefit. Another advantage is the simplicity and flexibility of management operations. Essentially, LLCs don't require a lot of the same regulation as a C corporation or some of the others that we've talked about, and flexibility over ownership, because LLCs can have any number of owners, or foreign investors or investments of other corporations. So there's some limitations and disadvantages I want to bring up. So the complexity of formation is more difficult than just completing the form to become a sole proprietorship. Something called an annual franchise tax, which essentially many states require LLCs to pay an annual franchisee tax, which is clearly a disadvantage. Foreign status in other states. You need new paperwork filed for each state that you're going to operate in, so that's kind of a pain, especially for expansion purposes. And there's limits on the types of formations. Excuse me. There's limits on the types of companies that can form LLCs. Now, this is specifically talking about the different types of LLCs, or the different firms. So up next, the term you've probably heard before is franchising. This is the last one we're going to look at today. So let's look at what a franchisee, right? It's a licensing agreement under which one party, the franchisor, allows another party, the franchisee, to use its name, trademark, patent, copyrights, and other property in exchange for monetary payments. Essentially, you're paying to have someone else's work done for you, right? There are 732,000 U.S. businesses that are considered to be franchises. Franchises make up about 8% of jobs, private sector jobs anyway, meaning that's a total of around 7.6 million employees work directly for those franchisees. There are two popular types of franchisee agreements: distributorship and business format franchisees. So distributorship is an arrangement in which the franchisor makes a product and license the franchisee to sell it. The business format franchise is a broad franchise agreement in which the franchisee pays for the right to use the name, the trademark, and business production methods of the franchisor. It has some advantages, such as less risk, right? Because you are not taking on ultimate risk. Franchisees offer access to a business system or a proven business plan. It's not just randomly guessing. You know, if you sign up to be a McDonald's somewhere, that you're following the McDonald's formula, which has shown to be successful. There's training and support provided to your business. There's brand recognition, which is great. You go anywhere, you see a McDonald's, a Chick-fil-A, a Burger King, you see it, you recognize it. It's a lot easier to run this type of business because you have all that support. And you have easier access to funding because banks are more willing to lend money to you if they know that it's going to be essentially a solid business plan being provided to them. So typically, a franchisee agreement requires franchisees to pay an initial fee when entering into that agreement, which is why cost is a disadvantage, right? Because you need that upfront money. There's lack of control, which is another issue. Because you can only do so much. There's a negative halo effect. So if one thing goes wrong somewhere, or irresponsible or incompetent behavior of a few franchisees, they could create a negative perception that adversely affects the business as a whole. And then we have growth challenges, which are a pretty big problem because it's not very easy to grow a franchisee or a franchise because of all the litigation that goes into it. You don't have total ownership of it. You can only follow certain rules. And if you want to expand in some way, shape, or form, you have to go through an entire process, right? So it could be a little bit more of a challenge, which is why that's a disadvantage. All right, that is going to be the end for Chapter 6. We will meet you again in Chapter 7.